If you're not careful, you could greatly reduce your dividend income by paying too much in taxes on those dividends. Dividend investing is a great way to create income and build wealth, but by doing it wisely, you can keep more of your hard-earned money in your pocket. In today's video, I'm going to show you everything you need to know about how dividends are taxed and how to keep more of your income so you can enjoy it. So the first thing you need to know is there's two types of dividends. There's ordinary dividends and qualified dividends. And this is the key differentiator. The goal is to get as many of your dividends to be qualified as possible. Here's why. So what we're looking at on the screen right here is this is a case study of clients we work with that had created $13,242 in dividend income. And you see that of the total $13,242, $10,880 of those were considered qualified dividends. And why that's important and why that's good to know is that qualified dividends are taxed at the more favorable long-term capital gains rate. So take a look right here. If you're married filing jointly and your income is below $94,050, you could pay 0% in taxes on those dividends if they're qualified. If your income's between $94,050 and $583,750, now you're paying 15% on those dividends. And if your income is $583,750 or more, now you're paying 20% on those dividends. But why is this important and why should you care? Because when you take a look at the marginal tax brackets, you can see that while 20% on your dividends might sound high, it could be a lot worse. You could be paying 37%, anywhere from 24 all the way up to 37%. So that's why making sure that your dividends are qualified can be a significant tax savings for you, because your non-qualified dividends will be taxed at these higher rates that you see here in our progressive tax code. That leads to the question, what makes a dividend qualified? And in order for a dividend to be qualified, it needs to be a company that's traded in the United States or an international company that trades in the US market. Also, you need to have held the investment for at least 60 days in a 121-day period, so roughly 3 months. So if it's a US company and you've held it for 3 months or more, now that dividend that's paid off is going to be considered qualified and it's going to be subjected to the much more favorable tax treatment. This leads to the next question. Should you have all of your dividends be qualified? And the answer is no. And that's because you do want some exposure to international companies as well for the diversification that it brings. Why do you want this? Well, even the US market, while it's been hot lately, it can go on cold streaks for long periods of time. The most recent one was 2000s through 2009. We had the tech bubble that burst, and then it led into the mortgage meltdown of 08-09, resulting in a 10-year period where the US market had zero growth over 10 years. Also, 1966 to 1982 and 1929 to 1941 were all periods where the US stock market really had little to no growth to show for it in long periods of time, leading us back to you do want some global diversification. Large international companies, small international companies, emerging markets, and also real estate. Now be aware that the income that's thrown off from REITs, real estate investment trusts, those also are not qualified. So be careful, because this income will be taxed at the higher rates. This leads us to a strategy known as asset location. Put the different types of investments that have less efficient or more taxable income, put those in your tax sheltered accounts like your IRA or your Roth IRA. So things like your REITs or your corporate debt, those are things that can go in your IRAs. Put your tax efficient investment vehicles in your accounts that are more exposed to taxes, like your trust or your taxable account. So the examples would be your US large cap fund or ETF or stocks, and your US small cap stocks. Those would be great things to have in a taxable account because they're more tax efficient. and then your tax inefficient vehicles can go in those qualified accounts because they're tax sheltered. So there's a whole lot of nuances to this. Key takeaways: qualified dividends are better than non-qualified dividends. They're at lower tax rates. And you don't want to have everything be qualified because that means that you're not diversified enough. And you want to locate your various investment vehicles in the types of accounts that ultimately result in the lowest tax bill, helping you keep more money in your pocket and grow wealth over time. I hope you found this video helpful. There's a lot of nuances and strategy to this. If you want help with your planning or you need some advice or guidance, feel free to reach out. My team and I are happy to help you navigate this journey. And make sure to like and subscribe the channel and share it with anybody who you think can benefit. We'll see you on the next one.